The US-China military AI competition represents more than geopolitical rivalry. It's catalyzing a fundamental restructuring of the global defense capital allocation. With US defense spending potentially reaching 1.5 trillion and venture funding in defense tech growing 18-fold over the past decade, we are witnessing the emergence of a new asset class. Critically, sovereign wealth funds, from Norway's 1.8 trillion GPFG to GCC's collective 6 trillion, are reconsidering decades-old exclusion on defense investments. This analysis examines the investment implications of intelligentized warfare and identifies where institutional capital is likely to flow. Hello everyone, welcome back to our channel and welcome back to this video. In today's video, we're going to focus on the capital war behind the AI arms race and how the US-China military AI competition is reshaping global defense capital flows. Let's start with the doctrinal divide, the two approaches to military AI. The US and China are racing to integrate artificial intelligence into their military capabilities, but their approaches reflect fundamentally different economic and political systems, with significant implications for where investment opportunities will emerge next. Let's start with China's intelligentized warfare strategy. China's military doctrine centers on what they call intelligentized warfare, a wholesale redesign of combat operations embedding AI from strategic command to tactical execution. The approach is characterized by centralized development with mandatory integration requirements, military-civil fusion that constructs commercial AI capabilities into defense applications, explicit timelines targeting a modernized PLA by 2035 and world-class forces by 2049. The recent analysis by CSET examined 2,857 AI-related procurement contracts published by PLA between January of 2023 and December of 2024. Revealing that the Chinese companies and universities outside traditional defense networks are emerging as key suppliers. The military-civil fusion is no longer just a rhetoric, it's operational reality. Next, let's look at the United States bottom-up innovation model. The United States approaches military very differently, asking technologists to build useful tools first and then working to integrate them into the defense system. The Pentagon's Artificial Intelligence Acceleration Strategy, launched in January of 2025, aims to establish US as the world's undisputed AI-enabled fighting force. But achieving this requires solving the integration challenge, getting innovative commercial technologies to work within the legacy military systems. Next, let's look at the investment thesis and where the capital is flowing. The divergent US-China approaches create distinct investment opportunities, with the US model particularly suited to private capital participation. When we are talking about the defense tech venture capital, let's look at the numbers. The defense tech venture funding has undergone a fundamental transformation. According to Bain & Company, the value of VC deals in the defense sector has increased 18-fold over the past decade. Crunchbase data shows defense tech startups raised $3 billion in 102 deals in 2024, an 11% increase from 2023's $2.7 billion. European defense tech startup has surged over 500% in 2021 through the 2024 period compared to the preceding 3 years. And there is also an institutional pivot that needs to be talked about. Major institutional investors are recalibrating their exposure. Andreessen Horowitz's American Dynamism practice focuses explicitly on US national security sectors. Journal Catalyst, Founders Fund, and 8VC have become significant defense tech allocators. The proposed US sovereign wealth fund, if established, would almost certainly include defense technology in its mandate. Let's focus on the sovereign wealth fund shift, which is a structural change that needs to be talked about. The most consequential development in defense capital allocation is the evolving stance of the sovereign wealth funds. These institutions, managing over 14 trillion globally, are reconsidering long-held exclusions on defense investments. The Norway's government pension fund Global, the world's largest sovereign wealth fund at 1.18 trillion, is reportedly considering opening its mandate to defense investments. This would represent a fundamental shift for a fund that has historically maintained strict ethical exclusions. The fund's sheer size means that any policy change would reshape capital availability for European defense companies. The Gulf Cooperation Council sovereign wealth funds collectively manage 6 trillion, more than 40% of the global total. Abu Dhabi's Mubadala deployed 29 billion across 52 deals, a 67% increase from the prior year. While traditionally focused on oil and commercial technology, the GCC funds are increasingly aligning with US defense and technology priorities. The strategic relationship with the United States now emphasizes AI and data infrastructure, reflecting convergent interests that extend beyond traditional defense procurement. The European institutions are also adapting requirements to enable broader defense investment. The UK's Mansion House Accord has unlocked substantial pension fund capital, some of which will flow to defense and space. National and multilateral institutions are adapting public funding vehicles, including the European Investment Fund and the European Sovereign Wealth Funds, to accommodate defense allocations. The NATO member nations recently agreed to boost defense spending targets from 2% to 5% of GDP, creating sustained demand signals for defense contractors. So, when we are talking about the investment opportunities, first and foremost, we have the AI native defense companies. Secondly, we have the dual use technology platforms. The third category would go to defense infrastructure and semiconductors, and the fourth category is formed by traditional defense primes with AI pivots. However, when we are talking about the risk factors and considerations, we have regulatory and policy risk, we have procurement cycle volatility, and we have ESG considerations. In wrap up, let's end with the relocation thesis. The US China military AI competition is catalyzing a structural reallocation of global capital towards defense technology. Several dynamics support this thesis. First and foremost, the budget commitments create sustained demand, with NATO countries targeting 5% of GDP for defense and US potentially reaching 1.5 trillion annually. Procurement pipelines are expanding dramatically. Secondly, the sovereign wealth fund policy shift unlocks new capital pools. Norway's potential entry into defense investing alone could redirect tens of billions of dollars towards the sector. GCC funds are already increasing exposure through technology and infrastructure investments with defense applications. Thirdly, the commercialization of the defense technology lowers the barrier to private capital. Unlike traditional hardware intensive defense businesses, AI native companies can scale rapidly with venture economies. The 18-fold increase in defense VC deals over the past decade reflects this fundamental shift. And for institutional investors, the question is no longer whether to allocate to defense technology, but how to structure exposure across the risk spectrum, from early stage AI native companies to established primes adapting their platforms. The capital war behind the AI arms race is just beginning. Now, that's what we wanted to share with you in this video. Hope you have enjoyed the update. Stay tuned in for our next one.